A Saudi Aramco oil complex in eastern Saudi Arabia. Higher prices could strain a Saudi agreement with Russia to hold down production. Saudi Aramco Vienna. As officials from some of the world's biggest oil producers arrive here in Vienna, they have plenty to be cheery about. Oil prices have risen unexpectedly fast of late, surging 20% since the beginning of September, providing much-needed money for the strained budgets of the 14 members of the Organization of the Petroleum Exporting Countries. That leaves OPEC members with a quandary: do they again extend production cuts first announced a year ago? What had seemed to analysts to be a foregone conclusion now looks to be more complex. The group of oil exporters, along with some non-members like Russia, agreed to the production cuts to ease a glut in the market and bolster prices. To some extent, that appears to have worked. Brent crude oil, the main international benchmark, is trading at around $64 a barrel, even after falling slightly this week. Some analysts see prices topping $70 next year. While those figures are well below the heights of more than $100 in 2014, they are more than double the price early last year. In a speech welcoming delegates to Vienna on Monday, the cartel's Secretary General, Mohammed Barkindo, spoke of a new optimism in the oil market not seen for a very long time. According to OPEC figures, the cartel has cut production by about 700,000 barrels a day from a year ago. Russia is holding back another 300,000 barrels a day. That trim, though, amounts to slightly more than 1% of global supply. A bigger influence has been a stronger global economy driving demand for oil. Economists have been upgrading their forecasts for growth worldwide, and that has affected demand, which has risen by nearly 5 million barrels a day since 2014. That is more than the total daily output of Iraq, OPEC's second-largest producer. The twin factors have recently helped make a dent in the substantial inventories of crude that had built up on tank farms, sprawling sites where enormous drums hold excess supplies of oil, around the world. Other events have played a role. Hurricane Harvey, which swamped oil installations on the Gulf Coast of the United States in August, caused major disruption and highlighted the dwindling stockpiles. All these factors prop up a higher price, said Said Al-Husseini, a former executive vice president at Saudi Aramco, Saudi Arabia's national oil company, who now runs a consulting firm. Political developments in Saudi Arabia and in other major oil producers like Venezuela are also affecting the market. Mohammed Barkindo, the Secretary General of the Organization of the Petroleum Exporting Countries, at a news conference this month in Vienna. Heinz-Peter Bederoiters in Riyadh. Two separate campaigns led by the kingdom's crown prince, Mohammed bin Salman, are raising questions. For one, a crackdown on corruption led by the prince has swept up at least 11 other senior members of the royal family. Though the effort has not disrupted Saudi oil flows, it has added to the uncertainty facing businesses looking to operate in the kingdom. Saudi Arabia is also pushing forward on the sale of a stake in Saudi Aramco, set for next year. A return to low prices might put that public offering, which is being spearheaded by the Crown Prince, at risk, giving Riyadh a major stake in ensuring that production cuts hold. I am not saying that Mohammed bin Salman is going to fail or be overthrown or whatever, said F. Gregory Gause, a Saudi expert and head of international affairs at the Bush School of Government and Public Service at Texas A&M University. But what I always thought was a very stable system is now embarking on changes on numerous fronts simultaneously. Political turmoil in Venezuela, a leading OPEC member, has also raised the specter of a sudden drop in its supply of oil. Production has fallen by 500,000 barrels a day, equivalent to around 20% of its output, over the last year. That decline is expected to deepen with the government behind on debt payments and unable to pay service companies crucial to the energy industry. Elsewhere, production and exports have fallen in Iraq because of tensions in the northern part of the country between Iraqi and Kurdish forces. While these trends have helped push prices up, potential developments could send them lower again, from the impact of shale oil producers in the United States to a collapse of the agreement on production cuts. American shale companies, in particular, are seen as the swing producers in the market, able to ramp up output to meet rising demand and take advantage of rising prices. These operators, from small companies to behemoths like Chevron and ConocoPhillips, have lined operations and can make money at far lower prices than in previous years. Current prices could lead to a surge in drilling. Higher prices could also strain an agreement between Saudi Arabia and Russia to hold down production. Russia has been rapidly drilling recently and could add up to 1 million barrels to its daily output over the next 5 years. as Western sanctions, a response to Russia's military moves in Ukraine and Syria and its meddling in the United States presidential election, begin to bite. Moscow's calculation could change. Russia is the kingpin, said Bhushan Bari, an OPEC analyst at IHS Markit. Cooperation between OPEC and non-OPEC producers, he added, would fall apart without Russian participation. Still, most analysts expect OPEC and Russia to extend their production cuts. While OPEC has often moved to stem price declines, it has less of a track record of constraining price increases. Exporters want to make as much revenue as they can, particularly to compensate for recent lean years. I don't think many of the OPEC countries think about the long-term aspects, said Bill Farren-Price, president of Petroleum Policy Intelligence, a market research firm. What they think about is how do we fulfill next year's budget. If we can have a few months of higher prices, he added, surely that is a good thing. Follow Stanley Reed on Twitter at StanLyReed12. Clifford Krause contributed reporting from Houston. A version of this article appears in print on November 29, 2017, on page B6 of the New York edition with the headline "With oil prices climbing, OPEC's leader cites producers' new optimism." Page 2. Amin Nasser, the chief executive of Saudi Aramco. We are in a market that is very dynamic, he said. Fayez Noureddin, Agence France-Presse, Getty Images. As Saudi Aramco, the Saudi national oil company, prepares for a widely awaited initial public offering next year, its chief executive, Amin H. Nasser, is at the center of the planning. Mr. Nasser has run Aramco, which produces more oil than any other company in the world, since 2015, and also oversees a wide range of joint ventures and investments. Along with the public offering, Aramco is also crucial to Saudi's efforts to cut oil production in an effort to buoy prices. Brent crude, the international benchmark, was above $100 a barrel in 2014 before tumbling sharply. It is now at about $60 a barrel. He spoke to Stanley Reed, a New York Times reporter, on the sidelines of an event sponsored by the Oil and Gas Climate Initiative, a partnership of 10 international oil companies that aims to reduce greenhouse gas emissions from the industry. Their conversation, edited for grammar, style and clarity, follows. QHOW. Will the privatization, or initial public offering, help Saudi Aramco? I think that privatization will definitely elevate, first, our international visibility as a company, our decision-making strategies, and also our achievements to date, and our governance. We know that we have excellent governance. A lot is not known about Saudi Aramco in terms of performance and all of that. So a lot of numbers can be shared later on, when we are listed. You will see, first of all, a lot invested in technology to add more value. While everyone else cut technology spending, we are increasing our technology spending. We have 8 technology hubs outside Saudi Arabia, and 3 inside Saudi Arabia, for a total of 11. 2 of our technology hubs focus on better fuel formulation, less carbon footprint, more efficiency in car engines. That all will hopefully, at a certain point, be shared with investors when we are listed. Do you have any doubt that the listing will happen? No, the listing is happening. You have confirmation from the Crown Prince this week, and our Minister of Energy and the Minister of Finance, all the stakeholders in the kingdom. It is happening in 2018. Is Aramco working on renewables, like wind and solar power? It is an important element of our strategy, to get into renewables. The kingdom, as I said, is looking at producing 9.5 to 10 gigawatts by 2023. So yes, we are interested and we are going to be a major player in renewables. Are your customers unhappy about your holding back production to honor your agreements with OPEC and Russia? We have a long-term relationship with our customers. They appreciate our reliability, the quality of our products. We value all of these relationships. We are always there when the market goes down and there are not enough resources, because we do have the spare capacity and we always meet our obligations. There is a requirement placed on the company, based on the cuts by OPEC members and non-OPEC members, and we are abiding by that guideline. Our customers and partners understand that issue, and because of the long-term relationship, it is not impacting our business transactions with them. They value the partnership that we have together. Are you losing market share? Everything is temporary. We are in a market that is very dynamic, and so far things are going well. We are meeting our obligations in certain markets, and there has been no issue so far. Are you happy with how the production cuts are working? We are seeing inventories go down, which is great. Don't forget, it was just an additional supply of 2 million barrels that brought the price from $100 to $40. Now, you don't want the opposite to happen. You need to make sure there is ample supply. You need to make sure inventories are balanced in a way where it meets the objectives of both the consumers and producers. So inventories are going down, prices are moving upward as a result of that balance between supply and demand. Is there concern in Saudi Arabia that, as renewables rise in importance, oil could become a stranded asset and lose its value? We don't subscribe to that thought about stranded assets. We think that oil will have more value in the future, and that rational development of our oil assets should be done reasonably over a long time. If you look today, the requirement is 98 million barrels per day. Over the last 3 years, demand has grown by 5 million barrels per day. Add to that, a natural decline of 5% in existing fields. So you need to bring additional crude reserves to the market to meet the natural decline, and to meet the additional demand that we are going to see. So I think oil will remain for decades to come. Transformation is happening, but it is going to take a long time. Follow Stanley Reed on Twitter at StanleyReed12.